pretty well, all things considered. The huge volatility in the first quarter of the year. When you look at the performances across all asset classes, including equities, but more so fixed income, they're positive. And that contrasts with the last 2 years, 2021, 2022, which were actually quite unpleasant years for emerging markets. All asset classes fell, 2 consecutive years of deep negative returns, which is quite rare in history. 1 year fine, but 2 years is just too much. And we always thought this year, 2023, would be different. For one thing, China's reopening is a game changer. Emerging markets have become a lot more dependent on China through trade, capital, currency stability, sentiment, and the fact that Chinese economic activity is actually rebounding and improving makes a huge difference for emerging markets. This is actually shown in our survey as well. Traditionally, emerging market investors were citing downside risk to EM, one of which that you've already mentioned, which is essentially the Fed and developed market rate hikes. The other one is the risk of recession or downturn in major global economies. But for the first time in quite a while in this survey, emerging market investors actually mentioned about an upside risk to the outlook of EM, and that's China. So that clearly helps. And the fact that Europe is resilient, doing better than expected compared to expectations late last year, that also helps the outlook. I think overall this year we're looking for a better year. For one thing, it's the growth outlook led by China. And the other one is the headline inflation is falling. And a lot of emerging market central banks, they've tried to fight inflation a lot earlier than their developed market counterparts, especially in Latin America. They've started hiking rates very early, some 1 year earlier than the Fed. So I think the combination of these two, the headline inflation falling and China rebound helping, gives a bit of a better environment and backdrop for emerging markets. And they've been performing well in the first quarter.
So then outside of China, where else were you seeing some of these inflows and some of this appetite for risk?
Sure. In the first quarter of the year, local debt markets have actually performed very well, up nearly 5%. That is a pretty handsome return, so to speak. About 2% came from currency. So another tailwind for emerging markets, which in the past used to be a headwind, is the weakening US dollar. And our FX strategy team, they've been actually calling the US dollar weakening trend for this year to carry on because US dollar has lost some of the momentum behind it that we had over the last 2 years. The Fed coming towards the end of the tightening cycle with the global economy not doing that bad, especially China rebound, etc., that are actually softening and weakening the US dollar. And that is helping a lot to emerging market currencies and local debt. Outside of China, there's a lot of interest in Latin America, especially large economies, Mexico and Brazil, but also Colombia, Chile. I mean, these countries have pretty high nominal rates and in many cases, very high real interest rates as well, with the inflation, the downside momentum, genuinely, external balance are in a good shape. China rebound helping them. We're already seeing this coming through. I think it's a good combination, and we are seeing a lot of interest for Latin American countries. And also on the equity side, GCC, Saudi Arabia, UAE, through IPOs, through attractive equity markets, a long-term story, a structural change, fiscal reform, diversifying the economies away from hydrocarbons or balancing the economies better, etc. These are all exciting stories, and we are seeing a lot of interest.
And what about the risk, though? I mean, risk appetite on a scale of 0 to 10, with 10 being the highest risk in emerging markets. Currently, according to your survey, has now at 6.9. It was at 6.1. How well-founded is that, given that we still have so many unknowns about the volatility, sure, about what central banks are going to be doing, and for how long?
Sure. Yes, every survey, there's a quarterly survey, we ask investors, what's your risk appetite at the current juncture? With 0 is no risk in EM and 10 full EM risk. And we take a weighted average. And as you were saying, the weighted average score has improved in our latest March survey to 6.9 from our previous December survey, 6.1. And actually, this latest 6.9 number is the second best in history. Another justification, or maybe confirmation of an improving risk appetite, is the fact that investors are putting their cash to work. Another question we ask investors is, what's the level of cash in your portfolio as a share of assets under management? And this has been going higher pretty much over the last 1.5 years. And we have seen for the first time in December and further in the latest March survey, investors are reducing their cash levels on a weighted average basis from above 6 down to near 5, which is actually a big change if you consider the whole portfolio of investments. And that is also confirming a better risk appetite and investors seeking opportunities across emerging markets.
And just very quickly, I know that when you were looking at the rebound of mainland China, investors honing in on base metals, tourism, and energy commodities as the key beneficiaries. How soon will they see that happening?
Correct. This is another question we ask specifically for this survey. What are the channels of transmission and spillover? And clearly, as you're saying, investors see base metals and tourism as the main areas, channels of transmission from China rebound to the rest of EM. Then comes consumption goods and energy commodities, and to a lesser extent, it's investment goods. So in a way, investors are looking for tourism, kind of, service exports to China, and also property market stabilization and rebound through the base metals to be the main areas of transmission to help the emerging market outlook with the China rebound.
I do appreciate you joining us with your insights this morning. Murat Ulgen, the HSBC Global Head of Emerging Markets Research. Thank you for your time.